Hey everyone, today we have a super interesting trade discussion, and that is going to be on none other than First Republic, ticker symbol FRC. They report earnings today, April 24th, after market close. Numbers on the surface look great until we remember why this is here. So let's dig into it. We have an implied move at 22.6%, huge implied move, with an average move less than 4%. That gives us a ratio of more than 5 and 3/4 to 1, with an implied versus average implied of almost 6. A max move of only 16%, and implied more than max is ridiculous. However, remember, why do these optics look so good? Why does this look like this? And it's because First Republic is one of the names that got absolutely obliterated in March, where the stock price, dropped by nearly 90%. They had to get bailed out by banks like JP Morgan and Bank of America in a loan package. That did save the bank. However, markets are still really afraid that, you know, they might not be able to pull through. This might not be able to make it. Retail has been talking about this thing nonstop. One of the top names mentioned, along with the likes of, the more common retail names like Tesla and Apple and Nvidia. And a lot of that is in preparation for these earnings, which are expected to be pretty dismal compared to previous quarters. However, what's really interesting about this is that this is such an abnormal event. So we can look at all this data here and be like, oh, okay, well, let's draw down here and, whatever. It doesn't matter. Like, take it, throw it out a window, right? And my personal opinion with events like this, they typically tend to be nothing burgers where, there's a bunch of fear, but it's irrational, which I think could be the case because they've already gotten bailed out. Like, as I said before with the previous trade discussion on Charles Schwab and other regional banks that we've done, there's been so many eyes on them for the past 2 months, give or take, that anything that could have been dug up was going to be dug up. And an earnings report is most likely not going to have anything that's going to completely throw the market out of whack. It's like, you know what I mean? Like, how worse can it get by them, saying before, like, hey, we need a bailout? Right? How much worse can it get? That's the real question. So, with that being said, I think that obviously with there being blowout risk, it may not be the best thing ever to take straddles here because of the infinite risk, right? To the upside downside. So I found this, and this is extremely interesting. So what this shows is this is showing the non-event IV10 versus the non-event IV30 on a spread, and then the IV10 versus the IV30 on a spread. If we look at the first spread, this is the non-event IV10 versus the IV10. We're in the top 5 percentile, right? So it's extremely high. So when the earnings event is gone, the non-event IV10 versus the IV10 is going to be extremely high. So what this is showing actually, again, going back through this, is that this ratio is so low. This is contango, actually. You'll actually see this down here. This is contango because the IV10 is actually having lower IV than the IV30, the non-event, right? So it's showing some of the strongest contango it usually shows, bottom 5 percentile. But then looking at the event included, severe backwardation, right? 1.31, the IV10 versus the IV30, right? So essentially, when this earnings event is gone, this spread is going to close, right? You can see that as this happens throughout every earnings cycle because there's no event anymore, right? For these options. Now, usually we see these move in tandem, right? Right? Which makes sense. I mean, usually there's drift and things of that nature. We are not seeing that here. So this could be a really interesting calendar trade. Obviously, more diligent due diligence is going to be needed, especially on a name like this. But really thought it was an interesting concept here because it's a bang for your buck kind of ordeal. You're getting exposure, but you're only risking $1.05 to possibly, make a pretty sizable return if we do get a nothing burger here. And that is what this is. So this would be selling the at the money call expiring this week and then buying the next monthly at the money call at the at the money strikes. Assuming that volatility hits, the forecast afterwards, this is what we could get. So it was really interesting considering the circumstances. Obviously, guys, again, if you have additional resources, use them. And if you have any questions, feel free to message me in the chat, and I will see you guys in the next one. Peace.